Yes, ma'am. We are streaming live.
Yeah.
Very good afternoon, ma'am. So,
Good
dear
afternoon.
students, we have around us CA Santhy Ganapathy, ma'am, who would be taking forward for Advanced Financial Management paper number 2, CA final. For the next 8 days, we all will be revising Advanced Financial Management. Over to you, ma'am.
Yeah. A very good afternoon to all of you. Have you received the worksheet? Have you gone through that? Are you clear with the chapters which we are going to revise? Yes. They will be responding through chat, isn't it?
YouTube chat, ma'am. YouTube live chat. Students have joined via YouTube live chat.
Okay. Now, I don't get to see anyone here. How do I go there? The link which I have come.
Can you go to the YouTube link? Yes. Can you go to the YouTube link and you'll find some chats over there?
Okay, ma. Just a minute. I think the YouTube link hasn't been given to me.
All right, ma'am. I'll share with you right away.
Yeah. Do you have my mail ID?
Yes, I do. I do have.
Yeah, please share.
Ma'am, I've shared with you the YouTube link
Yeah,
over
just
mail.
now I got it, ma. 1 minute.
Got it.
Yeah, now I've got the YouTube link. Yeah, okay. Yeah. Okay, we'll just get started.
Yes, ma'am. We can start it right away.
Yeah. Can you see what I'm sharing now?
Yes, your screen is visible.
Yeah, okay, fine. Now, these are the topics which we are going to see. I think there is some lag, isn't it?
Yes, ma'am. There will be a 15 to 20-second lag between what is available in WebEx and what is presented in YouTube.
Okay, fine. Never mind. Now you can see what I am sharing, right?
Yes, totally.
Okay. We will be first dealing with advanced capital budgeting decisions. That's what we plan to do today. And then the next 7 days, whatever I'm going to do, I have already given you there. First, let's get started with certainty equivalent approach. Now, when we are looking at capital investment appraisal, we have various techniques. Now, this chapter is important for final, especially the coming exam. The reason being, this has been removed from the intermediate syllabus and now it has come to final. So you know, as you're aware, any chapter that has been added will definitely be important for that exam. When we make an investment, there are three possible outcomes. They are: one, the cash inflow which you get from the investment can be certain. Two, the cash inflow can be uncertain. And three, it can be risky. These are the three possibilities. Okay. What is the difference between uncertainty and risk? Are they same? If we look at uncertainty, under two possible scenarios, we say that it is uncertain. One is, we do not know what the range of outcome is. Two, we know the range of outcome, but we do not know the probability of those outcomes. These are the two possible situations. Is that clear? Uncertainty is a situation where range of outcomes is unknown, or the various possible outcomes have been identified. This is different from risk. This is different from risk in that project risk arises when you know the range of outcome. You also know the probability of the various outcomes. That is, project risk arises when one of a range of outcomes may occur and the probabilities can be objectively assigned to the various outcomes based on past relevant experience. Now, the certainty equivalent approach is incorporated for situations where you have uncertainty. That is when we will use certainty equivalent approach. Under certainty equivalent approach, what we do is we split the uncertain outcome into two. We segregate the cash flows into two components. One, those that are certain. Two, those that are uncertain. A certainty equivalent factor is assigned to each year's cash flow depending on the degree of certainty. The cash flows are converted to minimum certain amounts. So while evaluating the investment proposals, only cash flows that are certain are considered. Since we are considering only cash flows that are certain, there is no downside risk, and hence cash flow is the risk-free rate. Now let us try and solve this problem. Let me give you a couple of minutes for you to try, and then we can discuss. You would observe that the certainty equivalent factor for the near future years are more than the distant future years because the visibility for the near future years is much more than the distant future years, and hence normally should have a higher certainty equivalent factor for the near future years. So how we approach this is we will adjust the cash flows, the future cash flows which we have, with a certainty equivalent factor to get the adjusted cash flow. Then we will discount the adjusted cash flow and then we will find the net present value. We will use the risk-free rate as a discount rate for finding the net value. So would you like to try? Why don't you try? Maybe we can just look at project X first, and then you can try project Y and we can discuss the answer. The cash inflows for 3 years, we have certainty equivalent factor for the 3 years given. We will find equivalent certain cash flow, apply the discount rate being 8%, which is the risk-free rate. And then we can find value of cash inflow and outflow to get the equivalent certain net present. Can you see the solution? How we found the net present value for project X? You can please try project Y and then we can discuss. The reason why I took advanced capital budgeting decisions as the first topic is logically also it is better we take that first sequentially. And even otherwise, this is something which you are most familiar because right from the intermediate level, you would have done investment appraisal. And hence I thought it would be better that we have. Is this done? Shall we move on to project Y? Did any of you try project Y? Now, what is our decision? Obviously, our decision is to choose Y. Why project Y? Because it has a higher net present value after adjusting for the uncertainty. That is, we have taken the certainty equivalent factor, and after adjusting that, we are you through with this? Shall we move on to the next problem? We already discussed the difference between uncertainty and risk. Uncertainty is a situation where the range of outcomes is not known, or even if the range is known, the probability cannot be objectively assigned. Risk is a situation where we have the range of outcomes and the probability of each outcome has been objectively assigned. I would suggest that you actually work out as we discuss and then check the answer. That would be the best way to do rather than simply taking a picture of the solution. You will have to actually work it out and check it out. Okay, I think that's enough time and let's move on to the next problem. Risk adjusted discount rate approach. As the name itself tells you, this will be used for incorporating risk in our capital investment appraisal. We are faced with three situations. The risk of the project can be equal to the normal accepted level of risk, or the risk of the project can be greater than the normal accepted level of risk, or the risk of the project can be less than the normal accepted level of risk. What discount rate we will employ depends on what level of risk, what is the relationship. If the risk is the same, discount rate will be equal to cost of capital. If the discount rate is greater, if the risk is greater, we will use a. If the risk of the project is less than normal accepted level of risk, then the discount rate will also be accordingly less than the cost of capital. Now, what do we find in the problem? There are three proposals. You are given coefficient of variation and asked to use coefficient of variation as the measure of risk. So the discount rate will be adjusted based on the risk. For each of these proposals, you are given the coefficient of variation, and based on that, you can make the selection. Accordingly, the discount rate will change and we will find the net present value. If you look at the certainty equivalent approach, we adjusted the cash flow, and since we already adjusted for the downside risk, what we had was the risk-free rate. Here, we are not disturbing the cash flow. What we are doing is we are adjusting the discount rate, choosing a higher rate for a higher risk and lower rate for a lower risk, and cost of capital for the normal level of risk. The selection would be project B. If you are through with this, then we can move. Now, one student has requested to show the question. That is what I am sharing. And I'm sure you all received the question also. There is a lag, no? That is why I think maybe you didn't see the. Can you see the question? Shall we look at the answer? Now, we have selected the discount rate based on coefficient of variation. Coefficient of variation is a relative measure of risk. And based on the discount rate, we have found the present value of cash inflow, deducted the initial outflow to get the net present value. As we have already seen, the difference between certainty equivalent approach and risk adjusted discount rate is that certainty equivalent approach is used when you have a situation of uncertainty. Risk adjusted discount rate is used when we have a situation of risk. What is the difference between risk and uncertainty? We already discussed. Okay. Now, shall we move on to the next one? Can I take it that you all completed this? Shall we move on to the next one? Next, we are going to discuss sensitivity analysis. So what is sensitivity analysis? Now we know that the appraisal of any investment proposal involves making estimates of a number of variables such as initial investment, life, annual operating cash inflow, annual operating cash outflow, discount rate, terminal value, etc. Now, the aim of sensitivity analysis is to seek out those variables of a project that could have the most adverse effect on the overall outcome of an appraisal. Supposing you expect something and you fall short of the expectation, how is the project affected? In other words, we can say we are interested in finding the margin of error of the various estimates when we use sensitivity analysis. There are two methods by which we can employ sensitivity analysis. One is we can compute the change in NPV for a given adverse change in each of the factors for which we want to test the sensitivity. So we will find the net present value with original estimate. We will decide on an adverse percentage change to be used for analysis. It could be 5%, 10%, 20%, something. And then we will study the effect of the given adverse change in each key variable on NPV. The key variable change which results in maximum reduction in NPV is the most critical. We are finding the change in NPV for a given adverse change in every factor. The same adverse change percentage is applied to every factor. But for that adverse change, the amount of reduction in NPV will be different for every factor. There is yet another way in which we can find the sensitivity. What we will do, we will compute the adverse change percentage in every factor for NPV is equal to 0. We will find the net present value of the project with original estimates. Then we will take each key variable in turn, one by one. We will find the estimate of that variable for NPV is equal to 0, keeping all other variables at the original estimate. Then we will find the difference between original estimate and NPV is equal to 0 estimate. We will find out how much is the percentage change. Then we will determine the degree of sensitivity. We are finding the maximum possible change in each factor to make the NPV 0. Here, targeted NPV is 0 to find the permissible margin of error. Hence, percentage change in factor is found as change in factor for NPV of 0 divided by original estimate for that factor. Either way, we can solve the problem. If the problem has not mentioned as to how you have to solve. We can find out for each factor for NPV is equal to 0, how much change will be there. Have you found the present value? Now, what do we say? We have the net present value at 10% to be 22,605. We have to take each one of these and find out for NPV is equal to 0, how much it can change. So first, if we take initial project cost, what should be the initial project cost for NPV is equal to 0 means it has to be 142,605. The change is 22,605. So the percentage change, you find out how much it is. The change divided by original estimate will give you the percentage change. Next, we will take annual cash inflow. Similarly here, we need to find out how much the annual cash inflow can change to make the NPV to be 0. We know that the annual cash inflow into annuity factor will give me the present value of cash. So what if I want NPV is equal to 0 means present value of cash inflow and present value of cash outflow should be same. So if I divide the initial project cost by the annuity factor, I will get the annual cash inflow, which will result in an NPV of 0. And therefore, I can find how much it is. Again, I can find what is the percentage change. Next, let us look at cost of capital. So here we need to find the IRR. We will see what is the rate at which NPV becomes zero or present value of cash inflow is equal to present value of cash outflow. And we have two rates which we can interpolate and find. And we find that the change to cost NPV is equal to zero is 84.58%. Now we find that for initial project cost, it is 18.84%. For annual cash inflow, it is 15.85%. And for cost of capital, it is 84.58%. Which is the factor to which the project is most sensitive means we should take that factor even with a small change. If it becomes zero, then that is the one which is most sensitive. So accordingly, we decide that annual cash inflow, that is the factor to which the project is most sensitive. Next, we can move on to scenario analysis. Have you all completed this? Shall we move on to scenario analysis? Now, scenario analysis is a technique which gives you a framework. You will have to look to different potential future scenarios and their implications. So anyway, first we need to find the expected NPV. Then we will get into the best and the worst case NPVs. Expected NPV, have you found? There are two ways of finding expected NPV. We can find the NPV for each outcome and then multiply with the probability and add to find expected NPV. This is one way. Annual operating cash inflow is there. Since we are interested in identifying the best and the worst outcome, see, always when you solve a problem, cultivate the habit of reading the requirement first. Supposing you do not want the best or the worst outcome, you simply want to find the expected NPV means, then we could have simply found the expected cash inflow we could have found. The next requirement, if you see, is finding the probability of occurrence of the worst case if the cash flows are perfectly dependent over time and independent over time. What do you mean by cash flows are perfectly dependent over time? Cash flows dependent over time means if the cash flows of subsequent years depends on what you have had as a cash flow in an earlier year, then we say that the cash flows are dependent. When we say they are independent means what you get in a subsequent year is in no way determined by what you got in an earlier year. So now, which is the worst case? The first case is the worst case. So the probability of occurrence of the worst case when cash flows are dependent over time means first year, if you get 1 lakh as the annual operating cash inflow and you continue to get 1 lakh every single year, that is the worst case. If they are independent, if they are dependent, the moment you get 1 lakh in the first year, you will continue to get 1 lakh. And therefore, if you have got 1 lakh in the first year with a 0.3 probability, since they are perfectly dependent, every subsequent year you are going to get only 1 lakh, it becomes 1. So the probability of occurrence of the worst case when they are dependent is 0.3. On the other hand, when they are independent, it means every year you have a 0.3 probability, and therefore it is 0.3 to the power 5. Next, you have been asked to find standard deviation and coefficient of variation, assuming that there are only 3 streams of cash flow. Now, the third sub-question, B part, took a deviation saying that they are independent over time. But if it's an annuity, they are dependent over time. So you go back to the original that they are dependent over time. And for that, they are asking you to find what is the standard deviation and coefficient of variation. Now we can find the variance and take the square root to find the standard deviation. Standard deviation by expected NPV would give you the coefficient of variation. Normal accepted level is given. And they also stated what you have to do when it is different. Till this, are you okay? Now it is stated in the problem that coefficient of variation normal range is 0.95 to 1. If for this it is less, then the project is less risky. Therefore, 100 basis points are deducted, and 100 basis points is 1%. And therefore, we deduct 1% and take that to be the risk-adjusted discount rate. Are you through with this? Should the project be accepted, you know that at a higher rate itself, you have a positive NPV. Therefore, at a lower rate, which is the rate applicable to this project, because the project is less risky, 9% is applicable, you would get a much higher net present value. But still, you need to find out at 9% how much is the net present value. When you do that, you find that even for the worst case scenario, the net present value is positive, and therefore you are interested in accepting the proposal. So are you through with this? Shall we move on to the next one in scenario analysis? Now, this is a very interesting question. Please try. Please try this question. This is a very interesting question. Have you completed this? Shall we move on? Till now, are you comfortable? Shall we move on? Shall we take up the next one? Yes, please try this problem. This is an interesting problem. What does the problem say? Required compute net present value for the worst case scenario. Compute net present value for the base case scenario and the best case scenario. Then, of course, expected net present value. And we need to distinguish between sensitivity analysis and scenario analysis. After solving the problem, we will do. When you look at the question, you find that they have given you lower estimates, base estimates, and upper estimates. They have not given you worst case scenario, base case scenario, and best case scenario. Is that understood? Have you observed that? That is a very important point to observe. In other words, what I'm telling you is, for some items, lower estimate would be good. For some items, upper estimate would be good. Is that understood? For example, if we take selling price, the least selling price is the worst case. If we take variable cost, the highest variable cost is the worst case. Are you able to appreciate what I'm saying? Accordingly, we should take the worst case, base case, and best case and give the solution. Please try. For sale quantity, the least is the worst. For fixed cost, the highest fixed cost is the worst. So accordingly, you have to find the cash flow and you have to find the net present value for the worst, base, and best case scenarios. As I was telling you, you will have to physically solve the problem and then check the answer. Then only you will find it effective. Have you found the annual operating cash inflow? Selling price per unit plus variable cost per unit will give you contribution per unit. Multiply with the sale quantity, you will get total contribution. Deduct the fixed cost, you will get operating profit before tax. Deduct tax, you will get operating profit after tax. Add back depreciation, you get annual operating cash inflow. Shall we check up the operating cash inflow? Please check up. Have you got it right? Now, once we have this, the cost of capital is given as 15%, and you're also given the probability. Therefore, we can find what is the expected NPV. We can get the NPV of the worst case and best. Apply the probability and get the expected. Are you through with this? Shall we move on? The next requirement is to distinguish between sensitivity analysis and scenario analysis. What is the difference between sensitivity analysis and scenario analysis? Now, both help us understand the impact of the change in input variable on the outcome of the project. However, sensitivity analysis focuses on assessing the impact of individual variables on outcomes, while scenario analysis explores a range of potential future scenarios involving change in multiple variables. In sensitivity analysis, you can change only one at a time, whereas in scenario analysis, more than one variable can change simultaneously. Is this understood? Now, sensitivity analysis ignores the interrelationship between the variables. It does not examine the effect of simultaneous changes in two or more variables. On the other hand, if you see, scenario analysis is based on a scenario. The scenario may be recession, normal, boom, whatever. All input variables can change. Some variables can change favorably and some other variables can change adversely. That also is possible. So scenario analysis computes the outcome considering where the variables are changed simultaneously. So from this discussion itself, we realize that scenario analysis is more complex than sensitivity analysis. And also, if you look at the probability, sensitivity analysis does not consider the probability of various outcomes. On the other hand, scenario analysis considers the probability of each. So shall we move on? Till this, do you have any doubt? Let us try this problem. Please try this. How many outcomes are there? Earlier, we saw different cash flows. Now, it's stated they are independent. How many outcomes are there? Please try. Since they are all independent outcomes, cash flows, year one, you could get any of these. Year two, you could get any of these. Year three, you could get any of these. Therefore, in all, 4 into 4 into 4, how many outcomes will be there? 64 outcomes will be there. You have been asked to find the expected NPV, not the NPV for each outcome. Therefore, what we can do, we can find the expected cash inflow and then find the expected NPV. Please do. Have you found the expected net present value? Expected cash inflow for each year. by taking the cash flow, multiplying with the probability and then adding. And once you have that, you can find what is the expected NPV. Up to that stage, have you completed? Till expected NPV, have you found? What is the next requirement of the problem? The company wants to know expected NPV of this venture, assuming independent probability distribution. That's why we said 4 into 4 into 4, 64 outcomes will be there with 6%. The next one is to find possible deviation in the expected value. You have the cash inflows. You know the expected cash inflow. You have to find the standard deviation. Please find. Please compute standard deviation. Let's just check it out. For each year, find the standard deviation. You know how to compute standard deviation, isn't it? Tell me what is the standard deviation for each year. Yes, have you completed? Shall we check up? You know how to find standard deviation? Now, every year you have the cash flows, 4 possible outcomes. You also have the expected outcome. So you can find the variances sigma p x squared minus sigma px the whole square. We already have sigma px here, sigma px the whole square. Standard deviation, of course, is the square root of variance. Please check up. Yes, have you completed this? Now let us look at what is the issue with regard to standard deviation. Expected value is only one. So standard deviation also we want only one. But here we have a situation where we have three standard deviation. There is another problem here. As far as standard deviation is concerned, it should be from the expected value. For expected value, we have taken NPV. So for standard deviation also, we should give standard deviation from NPV, not from cash inflow. There is a third problem. NPV would consider time value of money. We would have discounted. But what you have taken here, what we have found for cash inflow, does not incorporate time value of money. They are future values. This is the third problem. How to solve this problem? How do we go about solving this problem? We need to do three things here. One, we want standard deviation for NPV. Two, there should be only one standard deviation. Three, it must have considered time value of money. There is another thing which we should know about variance and standard deviation. Variance does not have the same unit as the base. Only standard deviation has the same unit as the base. That is why we take the square root of variance and find standard deviation. Because originally, deviation. So now, how do we go about it? We should combine the 3 years standard deviation to make it one. We should also consider the time value of money. But whether we take cash inflow or in this NPV, that is not going to be a matter because anyway, the same amount of cash outflow, capital outflow is considered. Always when we work with variance, that is, we want to combine, we want to split, we should be operating only with variance because that was the base thing for us and not standard deviation. So what I should do, I should consider the variance. I need to add it, but then time value of money should be incorporated. And therefore, since I know that the numerator is a square, the denominator discounting also should be squared. This is how I go about finding standard deviation of expected NPV from the variance which I have for the 3 years cash inflow. Please note down this. Is this clear? What have we done here? We are operating only with variance. Since we want to add variance for 3 years, we need to look at the discounting also, and therefore, since the numerator is a square, denominator also discounting we have squared. I strongly recommend all the solution, you please work out and check the answer. Do not simply note down the answer or just take a Now, this is one way of doing it. There is yet another way in which we can do that. You will find that that way you do also, you get the same answer, except of course, some small difference because of rounding off. Yes. Have you completed? Have you understood? So either way you could do, you can work with variance or you can work with standard deviation. That is, the discounting part can be done either way. Anyway, what we are working is only with variance. Either I can keep the variance as it is and then square the discounting part also, or I can take the standard deviation, discount it, and then square. Either way is fine. Hope you have completed this. And are you comfortable with whatever we have done till now? Then we can have a break and then continue. Okay, let's have a break. Yes. Are you back? Shall we continue? Now, the next, what we are going to do is this. We are going to look into replacement decisions. When we talk about replacement decisions, what we are looking at is when you replace a machine. If you replace a machine every year, the advantage is that towards repairs and maintenance, you will incur much less, and towards salvage, you will get more. As the machine gets older, towards repairs and maintenance, you will incur more, and the salvage value which you get, the resale value which you get, will be less. Then why is it everyone is not replacing every year? The reason is that you will have to incur the capital cost. So obviously, we are not interested in replacing every year because that involves capital cost. Therefore, we have to strike a balance. You have a capital cost outflow, you have a repairs and maintenance outflow, you have a salvage inflow. You need to balance this and then decide how you want to go about it. Is that clear? So what is the question about? We are interested in deciding on the optimal replacement cycle. How many options are there? The age of the machine is 4 years. So the maximum you can hold is 4 years. But the other options are you can replace every year, you can replace every 2 years, you can replace every 3 years, or you can replace every 4 years. Among these, which is the one you choose? The question. Please try. Once you try, we will discuss. The options are replace every year, replace every 2 years, replace every 3 years, and replace every 4 years. You have to balance the capital outflow and repairs and maintenance outflow with the salvage inflow. As the machine gets older, you will find that the repairs and maintenance goes up, which is an outflow. The salvage comes down, which is an inflow. That you have to balance and get a solution. Please try. Now, one thing you should remember is when we are looking at replacement cycle of 1, 2, 3, and 4 years, the life of each proposal is different. That aspect has to be borne in mind. Considering that aspect, you solve and give me the answer. When you have proposals with different lives, what we need to find is an equivalent cash flow. Equivalent cash flow, equivalent net present value. We need to find out for 1 year what is the position. Only then they become comparable. Now let's first consider for 1 year. That is replacement cycle of 1 year means every year you want to replace. If that is the case, what happens? You will incur the purchase cost. You will incur the maintenance cost. Purchase cost will be beginning of the year and maintenance cost will be end of the year. Then for repairs, scrap value, there is an inflow of 32,000. So we will see what is the present value of cash outflow. But then we need to find the equated annual flow. Equated annual flow would be whatever is the present value of cash flow divided by the annuity factor. On the same lines, you need to find for replacement cycle of 2 years, 3 years, and 4 years. Now you might wonder why the present value of cash outflow for 1 year has been divided by the discount factor. Because when we take the present value of cash flow and divide by the annuity factor, let us say it's for 2 years, then it means what we are finding is if the same amount had been incurred every year at the end of the year, what it will be. Now, this present value of 46,087 is a present value. That is if it's incurred now. But all others, if you see, we are going to take if it is incurred at the end of each year, how much. So this also, for comparison purposes, should go to the end of the year. And that is why we are dividing by the discount factor. It's just 1 year, therefore the discount factor. Had it been 2 years, we would have added the discount factor for 2 years to make it the annuity factor. Similarly, find for 3 years, 4 years. Then finally, whichever has the least outflow, that is what we will take. What is the meaning of this 44,536? The meaning of this 44,536 is incurring 60,000 now, 16,000 at the end of first year, receiving 2,000 at the end of second year. That is a cash outflow of 60,000 year 0 or beginning of year 1. Cash outflow of 16,000 at the end of first year. Cash inflow of 2,000 at the end of second year is equivalent to 44,536 outflow at the end of first year and another 44,536 at the end of second year. That is the mean. You please do for 3 years and 4 years, then we will see what is the decision, what is the final conclusion. Let's see for 3 years, what is the position? What this 43,114 means is that having an outflow of 60,000 in year 0, 16,000 at the end of first year, 22,000 at the end of second year, 12,000 at the end of third year is equivalent to 43,114 at the end of each of the 3 years. Only if we find an equivalent cash outflow, annual cash outflow, they become comparable and we can take a decision. Otherwise, we can't. The fundamental principle for decision making is that the base information on which the decision is to be taken should be comparable. In fact, your very compounding and discounting is because of that. Then coming to 4 years. Now, when we will choose that option which has the least annual cash outflow, equated annual cash outflow. So our decision is replace every 3 years. Have you completed this? Have you understood? Have you clearly understood? Well, let me stop sharing this. Now, next we are going to look at security valuation bond. That will be the next topic we do. Advanced capital budgeting decisions. Are you clear? Are you clear with advanced capital budgeting decisions? When we start with bonds, the first thing we need to discuss is the risk associated with bonds. What are all the risks associated with bonds? Yes. Can you tell me what are all the risks associated with bonds? Do we have risks associated with bonds? What risk do we have? Next one would be security valuation bond. For that, the first thing we need to discuss is what are all the risks associated with bonds? What risk do we have associated with bonds? What risk do we have? Yes. What are the risks associated with bond? Are there risks associated with bond? Yes, of course. What are the risks? What are the risks associated with bonds? The first risk that is associated with bond, what I will do, I will list out certain bonds so that you can think about what are the various risks. We can discuss them. Is it okay? So first, let us say default risk. Now, I might use various risks, but some of them, couple of them might mean the same thing. I want you to tell me whether they are different or same, what is the difference, like that. I'm typing all the risks associated with bonds. It might be possible for you to club one or two. That is, I might have typed two things which mean the same thing. So you should know both ways of representing that. So many different risks are there. Yes, you can see, isn't it? So what you can do, you can explore, you can look at this, tell me what these mean, or rather think about it, what these things actually mean. Now you have had enough time to think about these risks. What are these risks? Default risk. Default risk and credit risk mean the same. What do we mean by default risk? Default risk is the risk that the issuer may not make the interest and principal repayment as per schedule. So, the default risk or credit risk arises because of the issuer. Default risk, why it can happen? It can be because of business risk, it can be because of financial risk, or it can be because of operating risk. Now, how to manage business risk is what you have learned in strategic management. How to manage financial risk is what we are learning in financial management. How to manage operating risk is what we are learning in cost management. Now, normally we say government securities are risk-free. What does it mean? It means that they are default risk-free. It means that they are default risk-free. When I say government securities are risk-free, they are not free of all risks. They are free of only default risk. Next, marketability risk. Marketability risk and liquidity risk mean the same. What is the meaning of marketability risk and liquidity risk? Now, if default risk or credit risk is because of the issuer, marketability risk or liquidity risk is because of the market. If you do not have a well-developed bond market, you might have marketability or liquidity risk. As an investor, as a bond investor, what is my primary concern? As a bond investor, my primary concern is that my interest I should get on time. My principal should be repaid on time. This is my interest. So, when we talk about default risk, it is about whether the issuer is fulfilling. Let us say I have subscribed to a bond for 10 years. It may be necessary that I need to exit early. For that, I need to have a well-developed bond market. That is why that is the second risk. Then, okay, I have a well-developed bond market, but then will I get the promised yield? So that leads to interest rate risk. That is, if the interest rate changes, will I be put to some risk? Is what we are seeing here. Next, when I say interest rate risk, bond investors are subject to interest rate risk on two counts. First, the reinvestment of periodic interest. Now, or the entire financial management, whenever there is an investment and you get a return from the investment, it is always assumed the return which you have got from the bond investment or any investment for that matter, even when we do capital budgeting, that is being reinvested. So the interest which you get on bond, that also will be reinvested. That reinvestment of periodic interest If the interest rate undergoes a change, that will also change. Then, if the interest rate changes, the price of the bond also will change, and hence I will have a capital gain or loss. So my interest rate risk is made up of two components: reinvestment risk and price risk. Reinvestment risk is the risk that the reinvestment of whatever you have received from the bond may not be at the contracted rate for the bond. Price risk is the risk at which a bond investor can sell the bond at the end of the holding period is different from the cost of investing in the bond. So both risks are there. They actually behave in the opposite manner. When interest rates rise, periodic interest can be reinvested at a higher rate, and hence there is a gain on investment. When the interest rates fall, periodic interest can be reinvested only at a lower rate, and hence it's a loss on reinvestment. But at the same time, when interest rates rise, the market price of the bond will come down because the going rate has increased, and hence there is capital loss. When interest rates fall, the market price of the bond will go up because the going rate has come down, and hence there is a capital gain. So what do we know now? If interest rate rise, I have gain on reinvestment, but a loss on price. There is a capital loss. When interest rate fall, I have a loss on reinvestment, but there is a capital gain. So we have covered these risks. Then you have inflation risk. Inflation risk is because of the economy. Is the purchasing power of money intact? Then political and regulatory risk is because of the country. Is it stable? Is the political and regulatory environment stable? Then currency risk is because of the forex market. Then call risk is as per the terms of the issue, there is a possibility that there is a provision to call early. Then of course duration risk is bond sensitivity to changes in interest rate. Longer duration bonds are more sensitive than shorter duration bonds. So these are the various risks which we should be aware of when we discuss bonds. Then the next thing we should be aware is the yield. Again, we have different yields. Another name for yield to maturity, redemption yield. Then of course, we have some more yields. You can look at the required yield. You can look at realized yield. You can also look at equivalent yield. These are the various yields we have. So The problem with this chapter is that the problems in the exam will only say yield. We have to understand what yield they are referring to. Have you understood what I'm saying? The problem will not state what yield they are talking about. Based on the context, we have to infer what yield they are talking about. Discount yield is the rate of return of a couponless security. Say money market instruments such as treasury bills. Bonds which have zero coupon, deep discount bonds. They all do not have a coupon attached to that. So discount yield is the rate of return of a couponless bond or security. What is the return? Yield means return. What is the return for the investor? The difference between the issue price and the redemption price will act as the return. Yield means return, will act as the return. Now, nominal yield or coupon yield. What is it? It is the stated rate of interest on the bond. So, if you express annual interest as a percentage of the face value, par value, then that is nominal yield. That is coupon yield. It exists only in name because you might have invested at a different price. So taking the face value does not make sense. Therefore, coupon yield. The problem is, see, I'm saying return. Yield means return. All the investments have two components of return. One, income. Two, capital appreciation. The income part, it is considered here. That is annual interest. But capital appreciation is not considered. Not only that, investment amount is not considered because I'm taking face value. That is the problem with nominal yield or coupon yield. Current yield removes one drawback of nominal yield. What is that one drawback? Investment amount is not considered. Therefore, current yield, annual interest divided by current price of the bond. All this you want as a percentage, therefore into 100 into 100. That is there. Always any return you give should be annualized, should be a percentage. That is a given. Return means it should be annual and it should be a percentage. Why so? We already discussed the fundamental principle in decision making is that the base information on which the decision is taken should be comparable. If I have many investments, some I will hold for 3 months, some I will hold for 3 years, some I will hold for 10 years. So if I just look at the return for the entire holding period, it doesn't make sense. Therefore, I should annualize. Then the investment amount will be different. For one, I could have invested 100 rupees. For another, I could have invested 10,000 rupees. So in absolute terms, if you take return, it doesn't make sense. Therefore, it should be a percentage. Out of 100, how much? So we discussed current yield. Current yield is I'm taking the market price. Then The next one is yield to maturity or redemption yield. Name itself tells you yield to maturity. If I buy at the current market price and hold it till maturity, how much I am getting? It is called redemption yield because it gives you what is the yield till maturity. You hold till maturity, what is your yield? Now, this yield to maturity concept, we already know. In capital investment decisions, we have come across this as internal rate of return. In equity, we will come about this as return on equity. And bond, the same thing, is known as yield to maturity. So yield to maturity means I refer to current market. Then I have what is known as required yield. Required yield means it is the minimum yield which the investor requires from a bond. It consists of two components. One, risk-free rate. Risk-free rate means what? We already saw. Yield on government securities. Are they totally risk-free? No, only default risk. So, risk-free rate. Then, risk premium. For all others except government, there is a risk. For that, there will be a premium. In bond, we call it required yield. In equity, we call it cost of equity. And in investment decisions, we call it of. Realized yield means the return earned by the investor over his holding period. Will realized yield and YTM be same? They will be same, provided the assumptions underlying YTM are valid. What are those assumptions? 3 in number. The bond is invested at the current market price and held till maturity. The cash inflows from the bond are fully and immediately reinvested at precisely the same interest rate as YTM. All coupon and principal repayments are made as per the schedule. So if you have any violation in any of these assumptions, then YTM and realized yield will not be the same. YTM in effect is the IRR. Then we have one more yield to discuss. Equivalent yield. Equivalent yield, name itself tells you equivalent. Equivalent yield restates semi-annual, quarterly, or monthly interest bonds into an equivalent annual yield, again for the purpose of comparison. So, if you have some fixed income securities whose repayments are not, rather, I won't say repayments, those payment of interest are not annual, then you need to, for the sake of comparison, you need to do that. Have you understood all the yields we are talking about? As I told you, the problem will not mention which yield they are talking about. Sometimes, I'm not saying always, sometimes they may give a wrong yield. What do you mean by they might give a wrong yield? It will be one yield, but they will mention some other yield in the question. So that you need to take care. You need to know how to go about it. So now, shall we get into the problem? Have you understood clearly the various risks which we have, and also the yield, the different concepts of yield? Are you clear? Is it clear? Can we look at it? Shall we solve this question? Yes. Estimate the current yield and yield to maturity of the bond. Yield to maturity, first current yield you estimate, then we will discuss about yield to maturity. There are two ways in which we can find duration. We will see both. One is formula, the other is knowing the concept of duration, how you will find. Yield to maturity. Again, there are two ways of finding yield to maturity. One is a shortcut method, the other is a proper method. The shortcut method will give only an approximate answer, whereas the proper method will give you an accurate answer. Have you found the current yield? Now, as I already told you, YTM we can find in two ways. Duration we can find in two ways. I'm just giving you some time for the concepts which we have learned to sink in. Have you found the current yield? Now, what can we say with regard to the relationship? If current market price is less than maturity, I can say yield to maturity is greater than coupon rate. Have you done this part? Shall we check up? Current yield, is it over? We already discussed there are three things. So, shall we check up? Have you found the current yield? Do you remember the three assumptions which I told you when you will have the same yield to maturity and realized yield will be same? Do you remember those three? Yes. Shall we look at it? So we have a situation where it is given that the coupon rate is 14%, but the interest payment is half yearly, therefore 7%. Face value is given, current market price is given, number of years is there, so number of half years. And what is the interest amount? What is the current yield? Current yield is if you buy and hold it for 1 year, what is the position? You can either take half yearly interest and then annualize it, or take the interest for 1 year and straight away find. Either way, it is okay. Is this clear? So we have done the current yield and the yield to maturity of the bond. Now, current yield we have done, as I told you, yield to maturity, there are two ways of finding it. First of all, yield to maturity means what? You should buy at the current price and hold it till maturity. That is yield to maturity. There are two ways of doing it. One is the shortcut method. The other one, the shortcut method, of course, gives only an approximate answer. The other one is a long method. Now let us see how we will do it. This is clear, isn't it? Now, with yield to maturity, the reference is to the current price. If you have a situation where the current price is equal to the maturity value, yield to maturity and coupon rate are same. We can understand this relationship because yield to maturity is what is used to discount the cash flow. If current price is less than maturity value, then yield to maturity is greater than coupon rate. If current price is greater than maturity value, then yield to maturity is less than coupon rate. We can have a situation. Now, what do we know now? We know that the current market price is 90. Correct? So, is it less than the maturity value to be redeemed at face value? Yes. Therefore, yield maturity is greater than coupon rate. We are aware of that. Now, how do we go about it? Now, what we need to do, we have already seen for bond, we call it yield maturity. For equity, it is known as return on equity. For capital investment, it is known as internal rate of return. So we have to find the IRR. How will we find the IRR? We will take two rates, interpolate and find. Now, by taking these two rates, we can have a shortcut method. You would have done that even at the intermediate level. You would have had that method, isn't it? Yield to maturity, that method you would have had. For bond, you would have done cost of equity, cost of all the cost of capital. Then you would have done cost of debt. How to go about it? Now, first, we will use the shortcut method. See what we are getting as a rate. Then we can use that and then use the rates to interpolate. We can do that. So what we do, that shortcut method, you know that we will take the interest, then we will take RV minus P, divide by the number of years remaining, and then divide by the average. So I plus RV minus P divided by N, the whole thing divided by RV plus P by 2. What do you mean by RV? RV means the redemption value. P, of course, stands for the current price. Is this clear to you? So that is how we get 8, and that is why we took 8% and 7%, or 8% and 9%. We have to accordingly decide which one we will get. Since we are getting 8.42, we first take 8%, find out what it is, and whether we have to increase the rate or decrease the rate. And then we will arrive at the correct rate. Is this clear? How we got this shortcut? Is it clear? Are you able to recall what you have done at the intermediate level? I plus RV minus P divided by N, the whole thing divided by RV plus P divided by 2. The idea or the logic behind this formula is that I want yield to mature. Yield means return. Return is made up of two components. What are those two components? Income and capital appreciation. Income is what? Interest. Capital appreciation is what? The difference between the redemption value and the price paid. The difference between the redemption value and the price paid is one time, whereas interest is every year. Therefore, I am annualizing the capital appreciation, which gives me a return in the numerator. When I divide, I should divide by the average price. That is the logic. Have you understood the logic? Is it clear? So, since we got it as 8.4, we will first take 8%, get the answer, see whether we have to increase the rate or decrease the rate, and then accordingly decide. Now we can interpolate and get the answer. So always we have to give it annual. So have you annualized? Do you get the answer? Next, we need to go to duration. Now, duration, I told you, we can look at it in two ways. What are the two ways in which we can do duration means? First is we will take the discounted cash inflow year-wise, multiply with the year, add it, divide by the current market price. This is one way of finding duration. Duration is the holding period for which interest rate risk disappears. Duration is the holding period for which interest rate risk disappears. Now, once you get this, so this is one way of doing it, or alternatively, we can use the formula. We will see both. So let's see how we go about it. You can since it's half yearly, you take 7 only, and we already got for half year. See, the nature and the timing of the cash flow will determine the nature and timing of the discounting. Since this is half year, discounting also has to be done half year. We have to find the discounted cash flow, multiply with the year, for the period or the half year, then divide by the current market price. When you add the discounted cash flow, you know you'll get the current market price because we have used YTM for the purpose of discounting. Now, the most important point here is that the question is asking you, assuming we have found the duration, assuming the intermediate coupon payments are not available for reinvestment, calculate the realized yield. Realized yield means how much did he actually get? Did he get the YTM? He will get the YTM only if the assumptions are valid. What are the assumptions underlying YTM? The assumptions underlying YTM is that you have received the interest and the principal payment. You have immediately reinvested. The assumptions which you have for IR, same assumptions are valid. That reinvestment amount should be there. Then only you will get. Have you completed this? So if you have not fulfilled your part of the deal, you are supposed to reinvest and you have not reinvested, then you won't get the realized yield. So do you have this? Number of half years is 10, interest amount is 70. Since you have not reinvested, it is as good or as bad as getting the entire 70 along with maturity only. Therefore, what you have is you invest 90 now and you get back 170. So we have to find out what is the rate. We know that YTM and IRR, they are the same. What is the rate that will make this 170 future value as 90% value? That is what we are saying. Find the rate which will make a 170 future value as 90% value. That will be the rate. If I have future value into discount factor will give me present value. If I have present value and future value, I can find the discount factor and find out what is the rate that this has the discount factor. This is clear. So if you are through with this, if you have understood, we can move on to the next problem. Next problem again is about duration, but something more. We talk about duration, we talk about volatility, we talk about convexity, and we also try to find out what is the expected market price. That is what the next problem is about. If you have completed this, we can go to the next problem. Now, duration formula you would have noted down. Steps, I think it is better you note down because you may not have had a clear idea by just looking at the solution. So please note down. Now, before you note down the steps, let's just discuss what you mean by bond volatility. We already saw that bond price and interest rates are related. What is the nature of relationship? They are inversely related. That is, if the market interest rate changes, bond price will change in the opposite direction. So the duration of a bond, it helps us in measuring the sensitivity of the bond's price to interest rate movements. Volatility is like beta for it. Bond volatility is a measure of the sensitivity of a bond's price to changes in market interest rate. How much does the bond's price change for a given change in interest rate? That is what we are looking at there. So let us see how to find duration, how to find bond volatility, how to find expected change in price. Let's see all that. So note down please. Find year-wise discounted cash inflows using yield to maturity as the discount rate. Current market price will be equal to the total of discounted cash inflows. Multiply year and discounted cash inflows. Multiply year and discounted cash inflows. Duration is equal to the total of year into discounted cash inflow divided by current market price. Bond volatility is equal to duration divided by 1 plus YTM. Duration divided by 1 plus YTM. Expected change in price is equal to change in YTM multiplied by bond volatility multiplied by current market price. Now, since bond volatility is measuring how much it will change, and since YTM and price are inversely related, what we will do is we can have a minus sign before that. Bond volatility is equal to, we can say, minus duration divided by 1 plus YTM. Or alternatively, we can consciously decide whether to add or deduct. Both are okay. What is the expected change in price? Change in YTM. So that gives me the cost multiplied by bond volatility. So that is the magnitude. We said bond volatility is similar to equity weight multiplied by current market price, which is the base. So why don't you try this problem? Please try this problem. I think formula you have already noted. Now we can find duration, we can find volatility, of course, current market price. we can find. Face value is there, coupon rate is there, years to maturity is there, yield to maturity is there. So what should I do? I should consider the cash inflows. That is interest for 5 years and maturity value. 10% discount rate should be applied. I will get the current market price. Multiply the year and the discounted cash flow. Divide the total by the current market price to get the duration. We already saw YTM and price are inversely related. Bond volatility, it measures the magnitude of change. So I know they are inversely related, so it has to travel in the opposite direction, therefore a minus. Is this clear? Okay, is this done? Next, what we need to do to find the convexity. Now, convexity is when you have big changes, duration has to be further adjusted. The volatility which you get with duration, that will not be sufficient. We need to make a convexity adjustment, which is what we are doing here. For that, what we need to do is, we need to find out how much ever is the change. What is the change here? What is the change here? How much is it changing? See, convexity provides us additional insight beyond duration. It is a correction factor. So when interest rate changes are huge, large, then we will use the convexity adjustment. What is the rate of change in this problem? What do they say? How much is it changing? 200 basis points. We already know 100 basis points means 1%. 200 basis points means 2%. In order to find the correction for convexity adjustment, what we need to do, whatever is the present rate, in this case 10%, the change 2%, we should add 2%. At 12%, we should find out what is the value. We should deduct 2%. At 8%, we should find what is the value. Please do that working. Find the value at 2%. Find the value at 8%. Whatever is the change given, you add, irrespective of whether it is going up or coming down there. We need to find out to make the adjustment both. So now have you done for 12%? Is it clear? Shall we move on to 8%? To make the convexity adjustment, the correction factor, we need to find for 12% as well as 8%. Okay. Now 8%, let us see what is the position. Now, what we need to do, we need to employ the convexity adjustment, the correction factor. So do you get this? We already found V plus, that is the value when you add the change. We already found V minus, that is the value when you deduct the change. So value plus, value minus, minus 2V0. That is twice the present value divided by 2V0 into delta by squared. We have this. Do you get that? So have you got the adjustment? Is this clear to you? So once we have the convexity adjustment, we will adjust and find. So to find the convexity, we need to take C, that is whatever we have found now, into delta y squared, how much ever is the change, into 100. So have you found the convexity adjustment? Shall we move? You have been asked to find using the intrinsic value. Intrinsic value is simply finding the present value, applying the discount rate, which we already found. Then applying the convexity, we have to find. Convexity adjustment is 0.4007%. So already based on duration, we have got 7.73%. Make this adjustment and then find. For 8%, this is what we get. Then similarly, you can find for 12%, what is the position you can find. you will find that what we did with convexity adjustment is close to the intrinsic value rather than the other. Is this done? So when we compare the answers, we will find that based on duration, what we have is something different. If we do it based on convexity, that is with the adjustment, that is when it is close. Now 12%, the intrinsic value, when you actually use the 12% rate, was 8738 point. This is 8739 point. Similarly here, it is 10,199. Here it is 10,197. Not much of a difference. On the other hand, if we had used duration, then you would find the difference is much more. So if you want to have a accurate answer, you need to have a convexity adjustment. That is what we are looking at here. Have you understood? Is it clear? You find that only when we make the convexity adjustment, it is closer to the intrinsic value. Intrinsic value on duration is making the adjustment, not taking the actual rate and finding out. Intrinsic value is taking the actual rate and finding out. When we take the actual rate and find out, that is the correct answer. So only with convexity adjustment, we are getting the answer. Is this clear? Okay. So are you clear? Have you completed? Are you comfortable? Okay. So let's meet tomorrow. Continue with security valuation equity. We will be mostly going in the same order as I have indicated here. After bond, we'll do equity and then portfolio management, then mutual funds, business valuation, mergers, forex, and international financial management. Okay. Let me end the meeting.